As President Trump's trade policies send shockwaves through global markets, the escalating trade war between the United States and China in 2025 could reshape the economic landscape forever. The question remains, can the world's two largest economies find common ground amidst rising tensions and soaring tariffs? The escalating trade war between the United States and China has reached unprecedented levels in 2025, with tariffs soaring to 145% on Chinese imports and 125% on American goods entering China. President Trump's approach to trade policy has been characterized by sudden shifts, policy reversals, and unpredictable announcements that have sent shockwaves through global markets. This report examines the evolution of Trump's tariff strategy toward China, his defense of policy fluctuations as flexibility, and the significant economic concerns raised by leading economists and market participants. The tariff conflict between the world's two largest economies has intensified dramatically in early 2025, following a series of retaliatory measures from both sides. The escalation began on February 1st, 2025, when President Trump increased tariffs on China by 10%. China promptly responded on February 4th with tariffs of 15% on coal and liquefied natural gas, and 10% on crude oil and certain manufactured goods. This initial exchange quickly spiraled, with Trump raising levies by another 10% on March 3rd, bringing the cumulative rate to 20%. China retaliated the next day with additional tariffs on American agricultural products, resulting in an effective rate of 54% on Chinese imports. The rapid back and forth culminated in mid-April with U.S. tariffs on Chinese goods reaching 145% and Chinese retaliatory tariffs hitting 125%. This trade conflict far exceeds previous tensions, with the S&P 500 losing over 20% since February and economists warning of potential recession. President Trump has vigorously defended his frequently changing tariff positions not as inconsistency, but as strategic flexibility. He illustrated this approach by recounting his decision to exempt car parts from tariffs on Mexico and Canada after the big three U.S. It's called flexibility. It's not called inconsistency, Trump explained, adding that I'll always have flexibility. But there will be very little flexibility once we start. This philosophy has manifested in a zigzagging policy trajectory, with tariffs being imposed, delayed, exempted, and adjusted across different sectors and countries. Most recently, Trump has signaled a potential softening in his stance toward China, telling reporters that the astronomical tariffs on Chinese goods will, quote, come down substantially. However, thus comments have been met with skepticism from Chinese officials, who dismissed them as signs of retreat and insisted that Trump eliminate all tariffs imposed on Chinese goods. The unpredictability of Trump's tariff approach has contributed significantly to market instability and broader economic concerns. Markets have experienced sharp pullbacks following conflicting messages from the White House about the direction of trade policy. After China matched Trump's tariff increases, financial markets worldwide plunged into their worst crisis since the COVID crash. The market's reaction is delivering a verdict, and we should take that seriously, noted Brendan Lacerda, Director of Economic Research at Moody's Analytics. Investors were blindsided by both the magnitude of Trump's tariffs and the strength of China's retaliation, leading to dramatically darkened economic outlooks. Economic modeling of the tariff impact shows alarming potential consequences. Under pre-pause scenarios, before Trump announced a 90-day pause for most countries, excluding China, the United States would have seen real consumption fall by 2.4% in 2025 alone, with real GDP declining by 2.6%, employment falling by 2.7%, and real investment plunging 6.6%. Even with the partial pause, many leading investment banks forecast that the hefty tariffs on China could drive both the US and global economies into recession. Over 1,500 economists have signed an anti-tariff declaration opposing Trump's trade policy, highlighting fundamental flaws in his approach. Economists broadly criticize Trump's focus on bilateral trade deficits as an inadequate measure for evaluating trade effectiveness. Dani Rodrik, a Harvard University economist specializing in globalization, described this emphasis as totally silly, adding, "It's totally silly. There's no other way to say it. It makes no sense." According to economic strategists, Trump's tariff policy contains internal inconsistencies. Peter van der Wel argues that tariffs can't be effectively used as both a negotiating tool and a tax revenue tool simultaneously. It's either luring companies back into the US to rebuild the US manufacturing base and forcing other countries to lower their tariff rates in exchange, or it means sticking to tariffs as an important revenue source. Additionally, economists point out that the reciprocal tariffs are not truly reciprocal, as they are clearly in excess of the tariffs that countries are levying the US on its exports. This excessive retaliatory approach stems from Trump's calculation method, which establishes the tariff rate based on the ratio of bilateral trade balance as a percentage of imports. The tariff escalations have caused significant disruptions across global markets and specific economic sectors. On Wall Street, companies with substantial business in China have experienced sharp losses. GE Healthcare, which derived 12% of its revenue from the China region last year, fell 16%. DuPont dropped 12.7% after China announced an antitrust investigation into its Chinese subsidiary as part of retaliatory measures. The hardest hit sectors globally have included technology, retail, and financial services, while healthcare and utilities have shown more stability. European luxury goods manufacturers and automakers have also suffered significant losses. These sectoral impacts reflect the complex global supply chains that connect economies worldwide and the difficulty of insulating any single economy from trade disruptions. Beyond immediate market reactions, economists warn that uncertainty about trade policy is causing businesses to delay significant investments, such as building factories, which depresses aggregate demand and employment. David Henderson, professor of economics at the Naval Postgraduate School, warns that even if Trump eventually rolls back tariffs, increased uncertainty will show up in reduced investment, and, countries that have retaliated may not fully return to previous lower tariff levels. President Trump's rapidly evolving and inconsistent approach to tariffs on China has created unprecedented economic uncertainty and market volatility. While the administration characterizes these shifts as strategic flexibility, economists broadly view the approach as conceptually flawed and potentially damaging to both the US and global economies. The extreme tariff levels now in place between the world's two largest economies threaten to disrupt global supply chains, increase consumer prices, reduce corporate profits, and, potentially trigger a recession. Markets have already rendered their verdict through significant declines, reflecting serious concerns about the economic outlook. As the situation continues to develop, with Trump now suggesting tariffs might come down substantially, while China demands complete elimination of all tariffs, the unpredictability that has characterized this trade relationship seems likely to persist. This ongoing uncertainty may continue to weigh on investment decisions, market stability, and economic growth prospects in both countries and beyond. In navigating these uncharted waters, the future of global trade hangs in the balance. Will President Trump's strategic flexibility lead to a breakthrough, or will the escalating tariffs plunge the world into economic turmoil? As both nations assess their next moves, the global community watches with bated breath, understanding that the impacts will reach far beyond borders. Stay informed as this trade saga unfolds. Join the discussion about how these policies affect not only United States and Chinese markets, but economies worldwide. Subscribe for updates and, hey, don't miss our in-depth analysis.